Welcome to Your Inheritance, your rights, your obligations, your responsibilities, with your host, Peter Bochnewich. In each episode, you'll learn insights from experts. If you're being sued over an estate or if you feel you're not getting your share, Peter's firm can help you. You can find this show at www.betrustlaw.com and on YouTube, Facebook, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Your Inheritance, Peter Bochnewich.
Hello and welcome to Your Inheritance. We call it Your Inheritance because your inheritance may be what's at issue in your life. And in these podcasts, we cover a broad range of topics with respect to trust and estate and inheritance issues, some of which may be your inheritance issues through discussions with other attorneys, legal professionals, medical professionals, and as we have today, professionals involved in the professional fiduciary management of estate and trust assets and investment managers. Our discussions are confined to the state of California. Now, the podcast folks need me to tell you this, and I need to say this. Nothing we're discussing today shall constitute legal advice to anyone, and nothing you view should be considered legal advice. If you like to give the office a call, if you have a particular issue, I'll be happy to consult with you. This is a discussion that is designed to be a service to you and to provide information. Today, we're going to discuss Investing for a Trust Fund, Part 2, a portfolio manager's perspective, a further discussion with Guy Kosov, with a little bit about how artificial intelligence may affect money management. Our guest today for a second visit to the podcast is Mr. Guy Kosov, a portfolio manager for California Wealth Transitions, which is a fee-based wealth and asset management firm based in San Diego, California, and he's actually with the MDG Wealth Management Group within that organization. Guy graduated with a BA in finance from Fresno Pacific University, and in 2018 was awarded a Chartered Financial Analyst designation, which is a very high distinction in his field. Guy is a seasoned portfolio manager and financial planner with a track record of success in helping clients achieve their wealth goals and has years of experience in the industry. We had a very long conversation last year about some of the topics we're going to revisit today. Guy's dedication to excellence and unwavering commitment to ethics make him a very trustworthy and reliable advisor. Before joining his current organization some years ago, Guy was a portfolio manager at PIMCO focusing on fixed income portfolios, which is, of course, an interest of most trustees who handle the affairs of elders who are often on fixed income portfolios. So, Guy, welcome to the podcast. Glad you could come back again.
Thank you. Thanks for having me.
So, first question, how's the market trending right now?
I mean, the market is trading really good, right? Like we're up almost 12% or a little bit over 12% on the S&P 500 since the beginning of the year. There's a little bit of a feeling that a lot of the gains for this year are being pulled forward. But, you never know. No one has a crystal ball. No one knows where the market is going to go. But we have a lot of great developments from innovation standpoint. And also the economy is relatively stable, at a good place.
When you say gains are pushed forward, what do you mean by that?
So the more correct term is actually pulled forward, right? Like so when we look an average year over the last, I don't know how many, 50, 60 years, the S&P 500 did between 7 to 8% return a year. This year, we're already at 12%, which is above the average, right? So there is probably a good chance that we kind of got to where we got this year already. And from here, the market might trade a little bit sideways, or, there might be some names that are going to benefit more than others. But this is the idea of stock picking might play a bigger role going forward in this year and in the upcoming years as well, probably.
I want to touch upon a topic that has been of great concern in the investment environment, in people's personal life environment, and certainly in the political environment. And that's the issue of inflation and inflationary concerns. has the last year of inflationary concerns affected investment criteria for fixed income portfolio investment, in your opinion?
Absolutely, right. I mean, we saw rates basically peaking on a 10-year treasury. We saw rates peaking at a little bit above 5%. That's a very significant step up from the 0.5% we were getting in 2022. That's basically a function of inflation, right? The Fed is trying to put a lid on inflation. They raised rates through the entire 2023 fiscal year, and now we are trading at around 4.5% on the 10-year, 4.4 today. It's a significant step up, and it's a significant opportunity for some individuals. If it's treasuries, we're talking about potential benefit of being state tax exempt, which is a great benefit if you live in California, less of a benefit if you live in Texas. But there's a lot of opportunity in that space. I would say there is less opportunity within the corporate market and the municipal market, but market dynamics change all the time.
Things have gotten better. Inflation, has it toned down a bit? And what's the outlook for the future from your perspective?
So the inflation measure that the Fed likes to look at is the core PCE. The core PCE, the target rate that they're aiming for inflation is 2%. 2% is the rate where they believe the economy is at neutral, right? It's not overheating and not overcooling. Right now, we're at 2.75 on the core PCE. So we are trending in the right direction. Yeah, the peak, we're closer to 7% on that measure. But it takes longer than we expected, and it's more volatile than we expected probably initially. It's very hard to say what is the driver, but we had multiple things coming from different sources. At some point, it was the housing market. So the owner's equivalent rent that was pushing inflation higher and it was being very stubborn and didn't come down. Now it comes from the financial services. We see insurance prices skyrocketing because of different catastrophes that occurred over the years and inability of the companies to raise premiums for many years until this year. So it comes from a lot of different sources. The good thing that we are in the right trajectory. So it's never linear like everybody think, right? It's never linear. Just like the market goes up in a weird way, and it's never linear. The same way inflation is coming down in a non-linear way. We also have a lot of forces that potentially can be deflationary when we look 5-10 years forward. If it's AI, or then if it's just the exponential growth of the online marketplace, which is putting some deflationary pressure on prices for goods. So there is a lot of things that are positive, but it's going to take longer. I will say that the Fed tends to be late, to raise rates, so it's probably going to be late to cut rates. But we'll see. So far, there was no reason to cut rates when the economy is doing pretty well.
So you think the long-term outlook for inflation right now is actually pretty good?
Yes,
and
I think that.
What can the Fed do to rein in the prospect of inflation expanding or rearing its head again, and as it did for a period of time, it was a great big concern. It was running at about 7% or 9%, I think, and people were. It seemed like there was a little bit of a panic about it, and that seems to have subsided. And what did they do, and what can they do going forward from your perspective?
So let's start with what did they do. So there is a few monetary tools that the Fed has at its disposal in order to cool down or accelerate the economy. And this is all obviously based on theoretical models, right? And as we know, economics is not precise science. But one of the tools that they have is to raise interest rates in order to slow down the economy. And by slowing down the economy, they're going to reduce inflation because there is less demand being created for goods and services within the economy. What did they do is exactly that, right? Like they raised rates from a 0, which we had during COVID, back to the current level, which is at 5.25 on the Fed funds rate, 5.25 to 5.5. It's a range. Did it help? Probably somewhat, but I think when you compare the economy that we're in right now relative to the economy that we were 20 years ago, it's a completely different environment, completely different economy. And I think the Fed has less impact on the economy relative to what it had before. So their impact is very minimal. And you can see that even though they raised rates very aggressively over the last year, the economy is still doing pretty good. Consumers are spending a lot of money. And in general, you don't see this momentum, being driven to the ground. Even though there are some lagging effects, it's been enough time to say that the economy is on solid pace of growth.
When you say the economy of today is not the economy of 20 years ago, it's just I presume you're referring to the things that we use in our daily life, online shopping, the explosion of device-oriented communicative technologies. What we're doing right now, I mean, wasn't available 20 years ago. Zoom meetings between people, just the way everybody does everything is changed dramatically.
Right. It impacts your productivity, right? It also comes to like a place where a lot of people deleveraged during the COVID bubble. A lot of people went on and refinanced their mortgages, and they paying almost nothing right now. They pay 3%, 3.5% on their houses, which is close to nothing. It's almost like getting free money. And that created a savings effect, a long-term savings effect for many of those people. So if you have another $1,000 or $2,000 a month in extra income, you're probably going to spend it. So Milton Friedman had a great theory called the permanent income hypothesis. So if you get a short-term bonus and you don't think it's permanent, you're more likely to save and be less, and you'll be more scared to spend the money right away, on different goods and different services. But if you know that this saving is permanent, you're more likely to go and enjoy the savings that you created and go and start buying more and going more to restaurants. And, this money is being put to work into the economy, and we're a consumption-based economy at the end of the day. So this is a permanent type of savings that people created for the next 30 years, and it has an effect. And
so the higher interest rates for mortgages is going to have a negative effect on the savings rate. I guess that's the corollary to that.
Right, but the counter to that is that we don't have a lot of activity in the housing market because there is not a lot of supply. So although you see prices on real estate go up at some markets, you still don't see the volume that we used to have before.
In terms of sales of units.
In terms of sales, right? Because right now it's basically at a point where, because of rates, a lot of those markets are unaffordable in the housing market, in the housing sector.
I wanted to talk to you about a topic that's come up, and you mentioned it already. You used the famous initials that's on everybody's mind, AI, the topic of artificial intelligence. And it seems to me, Guy, that artificial intelligence, its effects, its possibilities, it's a topic certainly worthy of discussion. It's on a lot of people's minds in just about every single walk of life. It's going to affect the legal profession. I'm sure it's going to affect your profession in a great way. We're going to talk about that. I think it's extraordinarily promising. Certainly there's risks. It's here. It's on its way. We have to deal with it. And I just like to ask the question in terms of how investment managers do their jobs. How is AI, artificial intelligence, affecting that currently?
So that's a great question. So we are in the early stages of AI, and there are some tools that are being developed, not just for investment managers, but for everybody. A big one there is Microsoft is developing different tools for different type of industries. I think for us right now, it just creates a better opportunity to improve your efficiency, your productivity by streamlining some type of research that you do, easier to access data at some points. It doesn't take away from the qualitative element yet of an investment professional. I mean, like I said, we like to quantify everything in economics and in finance, but sometimes investment decisions and economic outcomes are not quantifiable because they're based on emotions and different other elements that impact
Exactly.
your decisions. And I don't see AI replacing that side of the equation anytime soon. Hopefully never, right? Like, I mean,
Full disclosure, Guy, understanding that AI is here and can indeed be put to good use. I asked an AI application the same basic question, and here's the answer that I got. AI is significantly impacting the work of professional money managers and investment portfolio managers by leveraging advanced machine learning algorithms. AI can analyze vast amounts of financial data in real time, identify patterns, and generate insights that can inform investment decisions. This technology enables money managers to make more informed and data-driven investment choices, potentially leading to improved portfolio performance. Additionally, AI-powered algorithms can automate certain tasks, such as data analysis and portfolio rebalancing, freeing up time for managers to focus on strategic decision-making. Overall, AI is revolutionizing the investment management industry by enhancing efficiency, accuracy, and decision-making capabilities. I asked that question in about 10 seconds, and I got the answer in about 5 seconds, which was pretty amazing. Do you agree or disagree with that?
So, I mean, I think AI has the potential to revolutionize every industry. It's some people compare it to like the new industrial revolution. Like that's how big AI is. Let's not forget that those outputs that you put into those softwares, it's data that is basically being recorded in the past, data that's available in the internet. So what are those machines like the ChatGPT and all those other tools that you have? Those are basically queries that run large amounts of data that is available online and creating an answer based on a certain algorithm or a certain pattern. Are those answers always correct? Probably not, right? I mean,
Right.
we know that. Are they good? Yeah, they have the potential to be good. So I think judgment is a big tool, and I think that's something that people need to keep in mind with any profession.
I think what you touched on earlier is that it's not going to replace the human element of having a discussion with someone about what they want to do, how they want to live their lives, the emotional component of decision making, lifestyle choices, quality of life choices, just so many variables about where a person might be age-wise with their health, what they want to do in terms of taking care of their children, what kind of legacy they want to leave, what they want to do charitably, and so forth. It seems to me that it could be a wonderful tool in terms of the assembly of data and the analysis of data, assuming that what it's going after is accurate data.
Correct.
And so, I mean, I think that it's unavoidable that it's going to be used as a tool, but just like, I mean, I think airlines for years have flown better with autopilot, far less accidents, but you don't want somebody not in the cockpit. You know what I mean? It's same thing with AI, with investment management. And one of the things I was thinking about is you want to be with a firm that has somebody who's experienced and is using it as a tool, but you're not replacing the human element, human judgment. Right?
100%. And I have the best example for you, right? Like not every client is the same. Not every client has the same emotional biases. And on a quantitative basis, a model can spit out data and suggest one thing, but knowing the client and know how he's going to react, or knowing how risk averse he is or not risk, or what a risk taker he is, adds a lot of value for investment advisors. So although a 30-year-old client, according to all the models, should take more risk than a 50-year-old client, but if the 30-year-old client, has the fear of losing money at a higher level than the 50-year-old client, it'll be very hard for you to build a portfolio that is more risky than for the 50-year-old client.
Right.
And the model might give you one answer, but knowing the client, know his personal circumstances, know anything about his life. If there's a potential future inheritance, there's a lot of other factors that cannot be put into a model. So that's something that you cannot take from the personal relationship that you build with your advisor.
So that would be some of the kind of identified risks associated with the sole reliance on AI is
100%.
the elimination. And you have even up till the point of AI in investment, even when people are talking about groupings in mutual funds, human beings would try to have aggressive, moderately aggressive, or conservative, like a fixed fund portfolio for people who are older and just need to make sure that the money's coming in. They're not quite as interested in growth. They're more interested in steady income. And those are the kinds of things that I think one-on-one conversations between an investment advisor and the client is always going to be necessary.
100%. And talking on that, I don't know if you remember 10, 15 years ago, there was a big hype around robo-advisors. Everybody were talking about robo-advisors, how you can get in, especially for the younger, crowd. You get in and you have basically a machine that tells you what you need, an algorithm that runs at the back of the website that tells you what you need to invest in and what is your potential outcome, and gives you all those type of supposedly qualitative tools. Well, there was a lot of hype at the beginning, but it didn't take off because obviously it cannot evaluate a human emotion, and it also cannot factor something beyond of the inputs that you're putting into the questionnaire or whatever they tell you, right? Like a lot of things are intangible that we don't talk about it. That it's more of a feeling that you get when you're talking to a person.
Oh, absolutely. I think a huge part of it is intangible. I mean, you want to have the information and the right data and the best possible predictive capabilities, those tools as to where things are going to go. But no matter what, you still want a live human being who knows what they're doing at the helm. I mean, right. I don't think that's going to change for the next, foreseeable future. I would think. I would hope that to be the case.
I would hope so too.
Right. So the next question I have is, we're talking about how AI affects your job and what you do and the modeling and the tools. How is AI emerging to affect company bottom lines by shaping workforces, hopefully increasing productivity and so forth? My view, hopefully not just replacing people, hopefully building into it that maybe we'll have more employment, not less employment. Is there any AI criteria that investment strategists look for in a company? Like, do you look at it like how are they employing AI in running their business?
Right. So right now, like I said, it's the early stages of AI. So everybody now expert in AI. Everybody like to throw the word AI, but it's more complicated than what it thinks. So what is AI? AI is taking a lot of data from different places, data that is being codified in a different way. It's not synchronized. Analyzing all this data and then spinning a potential outcome or potential solution for something or improving a process. The biggest problem the companies have right now is unifying the data, right? The data is being recorded in different languages. The data is being recorded in different manners. Think about a multinational company that has operations in Japan, in the US, in Africa, or any other place. Think data comes from all over the place. The data is very different. So how do you compare this data? How do you analyze this data? And I think that's the first stage that companies are now trying to figure out, right? This is what Microsoft is trying to figure out. This is what a few other companies that are in that space are trying to figure out. The second part for AI is, although we have the technology, we have the ambition to develop AI pretty quick, we have a significant limitation in terms of electricity. All this computing power requires a lot of electricity, a lot of power generation, a lot of grid that we don't have currently. So that's one limitation. The other limitation is it requires sophisticated chips. So so we see a lot of development within that space. It's getting better, by the day, I would say. But there's a lot of limitation before AI is really, really getting to the level where it's transformative across the spectrum. So right now we see small productivity gains within companies, and I'll give you an example. Microsoft has this service for doctors that basically records you go to a checkup with your doctor, it records the meeting, and then it summarizes the meeting, and then the doctor is giving you the treatment or whatever you need. It summarizes the treatment. In general, they saying it saves the doctors 2 hours a day in recording notes after every time they meet with a client, with a patient. 2 hours a day is basically extra 2 hours that you can see patients, right? So more people are getting treatment, more people are getting healthy. 2 hours, you see more patients, that means that you build the insurance more, right? So the doctors are making more money is being infused into our economy. That money will be spent at some point on something. So there's like this cycle, right? So people are getting healthier, people live longer, people make more money, work more. So this is the productivity gains that you see, but it's long-term productivity gains. It's not immediate. In terms of replacing people, I don't think we're at a stage where we can replace people. There are a lot of developments in terms of client relationship management with AI and all those little factors, but you still need the human supervision in place. But it is improving productivity. Improving productivity, that means that companies will make more money. Companies will make more money. Bottom lines are gonna grow. Margins are gonna expand, and people will be able. You will be able to utilize your workforce to more efficient tasks, right? And the best analogy, if you remember back in the day, you had an assistant or multiple assistants. All they did is check your mail, right? Like physical mail, and go and drop the mail between the different offices. Today we have emails, right? Everybody get their personal email and they improve from there.
It's changed jobs, but it hasn't decreased jobs.
Right.
You're just doing something else. One of the things that you brought up is, and I think a lot of people may not really appreciate this or realize this, because we're so used to getting new electronic technologies and plugging it in, and presto, you have this electronic device that's working. But the amount of electricity that all of these technologies, the juice that they use, right? I mean, is enormous. And then if you add on to that EVs, robotics, and things of that nature, we need to greatly increase the supply of available electricity by leaps and bounds. Is that a topic in the investment community about the supply of that to power the future, if you will?
Absolutely. I mean, this is a big topic. I think that is starting to come up front, and more people are talking about it. We have this ambition of like a green environment. Everything is generated from green energy. The reality is that if we're going to do that, we won't have enough grid to support all those innovations that we have. The reality is that we need any source of energy that we can use. If it's green energy or if it's traditional oil-driven energy, everything needs to be used in order to create more grid and power those technologies forward. The computing power that it takes. So you were talking earlier about running a small script or a small question on your on your device, on your application. Running this like small script, small question is probably taking more electricity than having your house like a living your house light on all day long, right? And that's something that we need to tackle. This is something that needs to be a priority. I know, especially in your area, the desert area, there's a big problem of grid because of the population growth that the area is experiencing.
Well,
hopefully this is something that will be top line for legislators in the coming years.
It should be. I mean, this is not, there's no political statement here. This is not a criticism. I think that when I'm forward looking. I think it's the future we want to embrace green technologies. We want to recognize, I think, the reality of climate change and all of those sorts of things in our economy. But if we're going to go electric, we can't just legislate the demand without doing something about the supply. If we're going to say we're going to have an EV-driven automotive lifestyle, 10 or 15 years from now, that might be great. But you put all that on the existing grid, then the rolling blackouts we might have in the desert or anywhere else, particularly in the state of California, would seem to me to be increased. So I think we have to, we absolutely want to look at clean technologies. We absolutely want to look at renewables, expand it. But I think we have to, I always thought we have to think about, a role of nuclear as a bridge to, as a bridge to getting us through, because the demand is going to come before the supply. We're increasing the demand, but we're not creating the supply, and I don't know how that's going to work out. It seems like it could stress the grid, if you will.
Yeah,
and I think it's something that can be fixed, though, and maybe AI can help us with that. Maybe 100%. AI can help us chart efficiencies or come up with engineering, types of things that will enable us to do things to create better sources of clean energy power, and then maybe those industries will emerge, and they'll be the new Microsofts or the new Googles or the new whatever, right in the future. Is there talk in the investment community about that prospect?
Yeah, 100%. I mean, there's a lot of talk about energy storage. So right now, with all the green energy, we don't have a good system to store the energy that we're generating. That is something that is being worked on. Companies are investing a lot of money into. The other element, everybody are talking about how AI is going to take away jobs, but think what we just described, right? We need more grid. How do you build more grid? You need more labor, more people to work for you in order to build that grid. So you're actually going to have more demand for labor. So maybe demand for labor will go down in some elements of the economy, but it will increase in other elements. So it's not like we're going to lose potential jobs. We actually going to have to increase the number of people employed in the economy in order to meet those ambitious goals.
That seems absolutely true long term, for sure. It would seem there will be. There might be some manual sorts of labor that will be replaced or assisted by AI technologies, robotics, and things of that nature. But when you think about the quality of life improvements, generally speaking, that technology has brought to the economy, and what is available to the average person that it could not possibly be fathomed, 50 years ago or 100 years ago, as to what information that you have. I mean, every person has all the information in the entire world practically at their fingertips through, the internet, through computers, through all of these different things that we have, and that's only going to exponentially increase. And we're seeing all of these things just explode. So I think that there's going to be opportunities for new employment, great new employment, and great new investment categories. So I think the future is bright, but it all seems to me to be geared upon supplying electricity, because that's what's going to drive everything.
Yeah, well, this is kind of, in order to eat, you need to create food, right? In order to create food, you need to put the seeds in the ground to grow the food. In order to grow the food, you need the water. So there's a lot of stages within that supply chain that will need to be worked on before it really gets to a stage where it's transformative on a level of like new drug discovery or reduction of car accidents. There is a lot of stages. The positive thing that it happens way faster than it ever before, right? I mean, it took 100 years for, I think, to get 100 million users daily with electricity. It took 5 years to get, or 10 years to get 100 million daily users on the internet. It took 5 years with Facebook, but it only took 2 months with ChatGPT to get 100 million daily users.
That's
That's
crazy.
phenomenal.
It is. I mean, I say it's astonishing. I say it's crazy in a good way. It just shows the impact of technology, and hopefully we can use these algorithms to figure out things that are going to help us address our climate change issues,
Right.
and address all of the types of issues that we face in society today. Touching briefly on the standard of care for investments and management, I'm looking at probate code 16047. When you're working with trustees, we talked about this the last time. It basically says that a trustee shall invest and manage assets as a prudent investor would, by considering the purpose, terms, distribution requirements, and other circumstances of the trust, and satisfying this standard, the trustee shall exercise reasonable care, skill, and caution. A trustee's investment and management decisions respecting individual assets and courses of action must be evaluated not in isolation, but in the context of the trust portfolio as a whole and as a part of an overall investment strategy having risk and return objectives reasonably related to the trust. Okay, so that's just me reading a standard of the code that sets forth a standard for trustees to make prudent decisions about investing money for their beneficiary clients, and as the trustee is looking to a portfolio manager to help them with that. Do you think that at some point AI applications will fit into the standard of care or the standard of what you're doing, and that we'll be discussing that? It'll be so ingrained in what we're doing that'll be a fundamental part of the standard of care and investments and management considerations from your perspective.
I think it can improve, the standard or the way the standard is applied to like different clients. But I think by nature, this is a very subjective topic, right? What is the best investment outcome or best investment advice for a 70 years old client that has, an abundance of money? I don't know, in theory, he's 70, right? Like he's relatively, he's at his liquidation stage. So you need more stability, you need more fixed income, but he has a lot of money too. So there is an opportunity to take some risk, right? Because you don't know how long he's going to live. Life expectancy is increasing.
Right.
So I don't know how AI is going to be evaluating those qualitative factors, but I do think it can assist us in determining if basic elements within the rule are met, kind of a checkbox, and maybe put more emphasis on the compliance side, that those boxes are being checked for every client, for every situation, and raise red flags when things are, relatively extreme or there is a potential for fraud, and notify somehow authorities or whoever needs to be notified. So it definitely can help improve the standards.
Well, Guy, it's been a very informative conversation. I want to thank you for joining us once again on Your Inheritance. We hope to have you back again as in the future as we see these things develop. And thanks for being here. That's all the time we have for today. And thanks for joining us, Guy. Really appreciate it.
Thank you, Peter.
You've been tuning in to Your Inheritance, your rights, your obligations, your responsibilities, with your host, Peter Bochnewich. If you're being sued over an estate, or if you feel you're not getting your share, Peter's firm can help you. You can find the show at www.betrustlaw.com and on YouTube, Facebook, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive feedback, comments, questions, and for sharing the show with others.